In this video, we discuss 10 tax-free sources of cash flow in retirement. Coming up next on Holy Schmidt.
Holy Schmidt!
By the time we're ready to retire, many of us are pretty savvy when it comes to taxes in retirement. This no doubt comes from the hundreds, maybe even thousands of articles we've read on the subject over the previous 30 or 40 years. There isn't anyone that I know of that wouldn't want to minimize taxes in retirement. In this video, we'll show you 10 areas that eliminate taxes on your retirement cash flow. Like most tax-advantaged vehicles, there are rules attached to utilizing these tax-free opportunities. But by using these 10 strategies together, or at least the lion's share of them, these rules are much easier to manage. All right, let's go. But before we do, please make sure you click the like button. YouTube uses the number of likes in its algorithm to push a video up in the search results, and I want to help as many people as possible. Number one is one that most of you have already heard of. It's called a Roth IRA distribution. One of the easiest ways to build mega wealth, especially if you have time on your side, is the utilization of a Roth IRA. Tech billionaire Peter Thiel accumulated $5 billion in his Roth IRA, and that came from one single $1,700 contribution. Peter bought shares in startups that he thought had promise, and one of the first, in fact, the first that he bought with his Roth IRA was PayPal for 0.001 cent per share. So he acquired a lot of shares for $1,700. 3 years later, that $1,700 investment was worth $3 billion, and he continued to invest from there. This got the attention of politicians, and that in turn created a rally against the wealthy having access to the Roth. So limits were put in place in terms of income to get into a Roth IRA. Here's how a Roth works. You fund your account with after-tax dollars, much like you would fund a traditional brokerage account with after-tax dollars. But the difference is that when you take the funds out of the Roth, the funds come out tax-free. You don't pay taxes on your withdrawals. So you have the opportunity to create a lot of wealth, especially if you have time on your hands. The Roth does have some limitations, though. Because it is a retirement account, you can't take funds out unless you're 59 and a half. And also, when you put your first contribution in, when you open your account, you have to wait at least 5 years before you withdraw any amount from the account, or you pay penalties and also taxes on that withdrawal. But in return for those limitations, your investments grow tax-free, and when you take the money out, you can spend all of it. Now, a very small portion of you will make too much money to contribute to a Roth. If you make $153,000 or more in 2023 and you're single, then you can't contribute to a Roth IRA. If you're married, that amount increases to $228,000 or more. There is a way around this provision using something called a backdoor Roth IRA. It's a complicated strategy, but if this is you and you make more than 153 or 228, then talk to your tax planner and they'll talk to you about how to execute a backdoor Roth IRA. Number two, the second tax-free source of cash in retirement is return of your investment capital. Let me explain. If you invest after-tax dollars and that investment grows, when you receive your money from that investment, part of it is a return on your capital and part of it is a return of your capital. So for example, if you invested $1,000 after tax money in a mutual fund and that fund grew from $1,000 to $2,000 over, say, a 10-year period, at the end of 10 years when you took the $2,000 out, $1,000 would be a return of your capital and $1,000 would be a return on your capital. So the return of your capital is tax-free, of course. Number three is cash rebates. Now, there are a lot of ways to get cash rebates. For example, I've talked about, on this channel anyway, the Capital One Saver Card, which gives 3% on any food purchases, grocery or restaurant purchases, when you use the Saver Card. Many grocery stores offer cash rebates, as do stores like Costco and Walmart. The requirement for these stores is that you use the debit feature on your credit card so that they don't incur credit card charges. Number four is healthcare benefits. Many people don't realize this, but when you use your health insurance and your insurance company pays for your medical charges, that is a tax-free benefit. They pay on your behalf, and you in turn get the services for free or for a reduced amount, depending on if there are co-pays and usual and customary charges, for example. If you have a $50,000 heart valve replacement surgery, the IRS doesn't send you a tax bill for 20% of the cost of that surgery simply because you didn't pay for it yourself. This is particularly powerful because those in retirement tend to be larger consumers of medical care than those who are not in retirement, all things being equal. Number 5, gifts, inheritance, and bequests. As we enter retirement, there's often someone older than us, still alive, that will eventually pass on either cash or property to us. Cash is called an inheritance, property is called a bequest, but in either case, you receive that tax-free in most cases, at least federal income tax-free. When this happens, this is generally a tax-free event, unless the estate is so large it breaches federal estate tax levels. For those who are single, the level is $12,920,000. For married couples, that's $25,840,000. Some states do have estate taxes starting immediately. Others have unusual rules. For example, here in New York, the estate tax starts at $6,580,000. However, if you reach 105% of that, everything, including the first $6.58 million, becomes taxable in the estate. Number 6, alimony. In most cases, the IRS doesn't tax alimony received if the divorce occurred on January 1st, 2019 or later. Given the fact that over 50% of marriages end in divorce, this is a particularly important point for the recipient of alimony. Now, the IRS doesn't give away anything for free. Even though the recipient of alimony doesn't pay taxes on that payment, the payer of alimony doesn't receive a tax deduction for making that payment. If you follow this all the way through, the payer of the alimony would have been in a higher tax bracket than the recipient of the alimony. Why? Because generally the person paying makes more money than the person receiving in a divorce. So if payer X spouse A was in the 25% tax bracket and recipient spouse B was in the 20% tax bracket, the IRS came out 5% less on the taxes. Still, we are where we are. So if you are divorced and you're the recipient of alimony and that divorce happened January 1st, 2019 or later, that payment is tax-free. Number 7, child support payments. Along those same lines, child support payments are not taxable on the recipient and are not deductible by the payor. Number 8 is the payout on a life insurance policy. And unfortunately, this one's all too common for retirees. When one takes out a life insurance policy and they pass, that payment goes to the recipient tax-free. Conversely, if you take out a life insurance policy, the premium is not tax deductible. Number 9, payment on a long-term care policy. Like life insurance, the payout on a long-term care policy is generally not taxable, as long as the benefit is used to pay for long-term care as identified in federally prescribed limits. Interestingly, the premiums can be deductible if they exceed 7.5% of adjusted gross income. So, for example, if you have $50,000 of adjusted gross income, anything in excess of $3,750 in premiums is deductible. Number 10, distributions from a health savings account. Health savings accounts, or HSAs, are getting a lot of airplay lately, and for good reason. HSAs are called the triple tax benefit vehicle. But like most things that seem too good to be true, it does come with strings attached. Let's talk about an HSA. First, let's talk about what it is. If your employer offers a high deductible health insurance plan, this usually allows you to pay less in insurance premiums. The reason I say usually is sometimes, on rare occasions, an employer will pay 100% of your health insurance costs, your health insurance premium costs anyway. And so in that instance, you wouldn't really want to choose the highest deductible plan possible. You'd want to choose the one that has the best coverage. But assuming you pay for a large portion of your health insurance premium, the higher the deductible, the lower the premium. But what if something happens to you and you actually need to use your health insurance? Enter the HSA. The HSA allows you to save for that rainy day and put the money aside in an investment vehicle in case you need it to cover the gap between where your deductible ends and your health insurance begins. The biggest drawback to an HSA is that many people think that it acts just like a 401k, meaning that you can take the funds out and spend that money on anything you want. But that's not the case. you get the triple tax benefit only if you spend the funds on qualified medical expenses. After you turn 65, you can use the funds for non-qualified expenses, i.e. non-medical expenses, but like a 401k, you will pay taxes on the funds that you withdraw. If you like this video, check out that video on how to pay zero taxes on Social Security. Also, don't forget to click subscribe and turn on notifications so that you get alerted the next time I post a video. I post once or twice a week. This is Jeff Schmidt. Thanks for watching.